Hello financial fans, welcome back to another stock analysis. Today we'll be covering Union Pacific, stock ticker UNP. Union Pacific is an American railroad company that operates one of the largest rail networks in the United States. The company provides transportation services for a wide range of goods including agricultural products, chemicals, coals, and consumer goods among others. Union Pacific operates in 23 states across the western two-thirds of the United States, serving major population centers and providing access to many of the country's largest ports. In addition to its transportation services, the company also offers supply chain and logistics solutions to help customers manage their freight needs. Union Pacific is committed to operating its rail network in a safe and efficient manner while providing reliable and cost-effective transportation services to its customers. They're currently sitting at a $229.3 billion market cap, and in 2021, they generated a revenue of $24.9 billion. The dividend yield is currently sitting at 2.47%. 36% of their revenue comes from industrial, 33% from bulk, and 31% from premium. Industrial being metals and minerals, chemicals, energy, and forest products. Bulk being coal, grain products, fertilizer, and food. And premium being intermodal and automotive transport. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard of margin of safety of 25%, and the margin of safety can never be below 0%. Margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up, going from almost $7.5 billion in 2013 to almost $10 billion in 2022. The average growth during this period in EBIT was 3.75%, meaning no change in the margin of safety. The margin has also gone up, going from almost 34% in 2013 to almost 40% in 2022. The average growth in margin during this period was 1.9%, meaning a 5% deduction from our margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from $3 annually per share in 2013 to $5.20 annually per share in 2022. The average dividend growth hereby was 7.3%, meaning a 5% deduction from a margin of safety. The payout ratio is sitting at a nice 45.3%, meaning no change in the margin of safety. The final two ratios are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Union Pacific, this is almost 3 years, in this case a 276% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital for Union Pacific is sitting at 11.9%, meaning no change in the margin of safety once again. Let's go look at the valuation models next to determine the intrinsic value of Union Pacific. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow annually during this period was just over 12%, and I'm projecting a growth rate of 9% in the future in free cash flow for Union Pacific. With this percentage, we can determine the future free cash flow and determine a terminal year valuation using a perpetual growth rate of 2.5% and a discount rate of 8.5%. Then we get a sum of free cash flow of $160.7 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $127.1 billion. To get our discounted cash flow price per share, we have to divide it by the shares outstanding, and this leaves us with a discounted cash flow price per share of $206.79, and with the current price of $210.29, it's very close to fair value looking at this model, with a downside of $3.50, which is almost a 1.5% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 14.3%, and I'm projecting a growth rate of 7% going to the future. And we're also once again be using a discount rate of 8.5% in this valuation. And this leaves us with a discounted dividend model price per share of $370.93. And with the current price of $210.29, we get a pretty massive upside out of this model of $160.64, which is a 76% upside. The third model that we'll be using is Graham's revised valuation formula, and this model will be looking at the earnings per share of Union Pacific, the growth rate estimate that Wall Street is projecting for the company, and the current yield of AAA corporate bonds. We'll also be using a metric of a PE of a company with no growth at 7, and this leaves us with a fair value out of Graham's valuation formula of $183.53, and with the current price of $210.29, we get a downside of $26.76, which is almost a 13% downside. The fourth valuation model is the multiple valuation. In this model, we'll be looking at similar companies to Union Pacific, look at their stock price and their earnings per share, so we can determine an average PE multiple in the industry, which in this case is 21.03. All we have to do to get our fair value is multiply by the earnings per share that Union Pacific is generating, which is $11.21 per share. This leaves us with a fair value of$235.73, which is a $25.44 upside out of this model, which is a 12%, just over 12% upside. The final model that we use to evaluate the stock is the mean reversion theory. In this model, we go by the theory that a company will always trade at its mean, above its mean, or below its mean, and we will be using the dividend yield and PE ratio as metrics. In this case, I've imported the dividend yields going from 5 years ago, and the average yield during this period was 1.87%, and the current yield is 2.47%, meaning it's currently undervalued since it has a higher yield. The PE ratio we've also imported from the past 5 years, and the average PE multiple during this period was 19.33. And the current PE is 18.76, meaning, once again, it's considered to be undervalued out of both metrics. Then we get a fair value out of this model of $246.90, which is a $36.61 upside. And in percentages, this is a 17.5% upside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, multiple valuation, and mean reversion prices per share, leaving us with an average of $248.78, which would be at 18.3% upside if we wouldn't consider our margin of safety to be used. But we have determined our margin of safety prior to this, using a standard margin of safety of 25%, deducting it by 5% for the margin growth, and deducting it by 5% for the dividend growth, leaving us with a margin of safety of 15%. Applying this margin of safety, we get a fair value of $211.46, which in this case would be a very small upside of 0.56%. So it would be a buy, but it's very close to fair value currently. If there's any other dividend companies that you would like to see me cover on this channel, please let me know, and thanks for watching.